Hello everyone. In this particular video, we are concluding the transfer pricing revision lecture. At first, we are going to see the primary and secondary adjustments. What is a primary adjustment? It is nothing but the determination of the arm's length price according to the transfer pricing provisions. And what is a secondary adjustment? It is nothing but the adjustment to be made as a result of the primary adjustments in the books of account of the assessee and the associated enterprise, and the repatriation of the excess money from the associated enterprise within 90 days. And the calculation of the 90 days depends on the following scenarios. Firstly, if the primary adjustment is made by the assessing officer, the 90 days is calculated from the order of the assessing officer. In all other cases, generally, it is calculated from the due date of filing return. Okay, what if the money is not repatriated within the 90 days? In such a case, the excess money lying with the associated enterprise shall be deemed to be an advance, and the interest shall be calculated at the specified rate from the due date of the return or the date of order of the assessing officer, as the case may be. Okay, what is the specified rate? If the primary adjustment is made in the Indian rupees, then the specified rate is SBI lending rate as on the first day of the previous year plus 3.25%. If the primary adjustment is denoted in other currencies, then the 6-month LIBOR rate on 30th September of the previous year plus 3% is the specified rate. Okay guys, now let us see the number of options available to the enterprise. So there are three options available to the enterprise. Firstly, the excess money can be repatriated from the particular associated enterprise. Secondly, the excess money can be repatriated from any other associated enterprise. Thirdly, it can pay additional income tax. Okay, now let us see what is the additional income tax. It is nothing but the income tax is payable on the primary adjustment at the rate of 20.9664%, which is nothing but 18% plus 12% surcharge plus 4% cess. Secondly, the amount paid as additional income tax cannot be claimed as deduction. Thirdly, the applicable interest shall be payable for the period up to the payment of additional income tax. Okay guys, let us understand the primary and secondary adjustment through an example. Carefully read the question. The assessing officer has made the primary adjustment of rupees 10 crore. The Beast Limited has repatriated the excess money, or the Beast Limited has paid the additional income tax in the following scenarios.
Okay guys, now let us quickly solve this question. First of all, I am drawing a time scale. The time scale consists of two financial years. In the question A1, the Beast Limited has repatriated the excess money on 15th January, that is within 90 days from the order of assessing officer. So, in such case, the Beast Limited is not required to pay any interest.
In question A2, the Beast Limited has repatriated the excess money on 31st May, which is more than 90 days from the order of assessing officer. So, in such case, the Beast Limited is required to pay interest. And the interest is belongs to two financial year. Since the primary adjustment is denoted in Indian rupees, we have to take the SBI lending rate as on the first day of the previous year. Accordingly, for financial year 2021, we are taking the SBI lending rate of 6%, that is 2.75% plus 3.25%. 10 crore into 6% into the number of days pertaining to the financial year 2021, that is 121 days, and we are dividing it by 365. And finally, we are arriving at the answer of 19,89,041. Likewise, we are calculating the interest for the financial year 21-22. Here, we have to make some couple of changes. Firstly, we have to take the interest rate of 7%. Secondly, the number of days in the financial year 21-22 up to 31st May is 61 days. So we have to take the 61 days. By doing the calculation, we are arriving at the answer of 11,69,863. In the question B, the B Limited has, instead of repatriating the excess money, has paid the additional income tax on 31st December 2020. So, even though the B Limited has paid the additional income tax, the interest is applicable. So, from the date of order of the assessing officer till the date of 31st December 2020, that is for 31 days, we have to calculate the interest at the rate of 6%. By doing the above calculation, we are arriving at the answer of 5,09,589. Okay guys, now we are calculating the additional income tax part. The additional income tax can be easily arrived at by multiplying the primary adjustment into 20.9664%. Thus, we are arriving at the additional income tax of 2 crore and 9 lakh 66,400. Okay guys, now let us see the section 94B, the limitation on the interest deduction. Firstly, we will see when does the section 94B shall be applicable. Section 94B is applicable when the interest is paid to the associated enterprise. Let us understand it through an example. Let's take Netflix on the one side and the Jio company on the other side. And let us assume Netflix is an associated enterprise of Jio company. So, in the given scenario, Netflix is providing loan to the associated enterprise Jio, and in return, Jio company pays interest for the loan taken from the Netflix company. Accordingly, Section 94B shall be applicable in the particular scenario. The second point of the applicability is loan provided by a non-associated enterprise, but equivalent money is either a guarantee or deposited by an associated enterprise. Then, in such case, the loan is deemed to be provided by the associated enterprise. Okay, let us continue with the above example. Let us take SBI Banking Company, which provides loan to the Jio company, and in return, Jio pays interest to the SBI Banking Company. On the other side, Netflix is providing guarantee or deposits equal money to the SBI company. In such a case scenario, the loan is deemed to be provided by the Netflix company to the Jio, and accordingly, Section 94B shall be applicable in the particular transaction. The excess interest is disallowed, and which is nothing but the lower of the following: the total interest paid, including to the non-associated enterprise, minus 30% of the EBITDA, and interest paid to the associated enterprise. However, there are some alternative view to the excess interest. Accordingly, the excess interest is calculated as follows: the total interest paid to the associated entity minus 30% of the EBITDA. And the other important point is the excess interest which is disallowed can be carried forward up to the period of 8 assessment years.
If you want to download today's lecture in the PDF form, you can download it from our Telegram channel. The link to the Telegram channel is given in the description.